Hello everyone, hi, welcome to the channel of Wall Street Mojo. Friends, today we are going to learn a concept that is called as beta. Beta is the most important characteristics which is used in calculating the capital asset pricing model, that is your cost of equity. So for calculating the cost of equity, beta is a very important component as a part of the formula because that changes the entire calculation, that changes the entire required amount of the return that investor may require. So let's see some of the components of the CAPM model and we'll be able to understand things in a much more better way. Cost of equity, which is known as the KE, that is the amount of the return that is required by the equity shareholders. So that is the amount of the cost that company needs to bear. So this is the risk-free rate, which involves, basically this is the formula, as you can see, risk-free rate plus your beta, that is the sensitivity of the stock to the market, into the risk premium. What is risk premium? Risk premium is the amount of the return that an investor gets because of taking the amount of the risk. So the premium is over and above the return that you get from the risk-free rate. So let's say your risk-free rate is 10%, then your risk premium should be 2% because 12% is going to be the return from the market, because that is the amount of the 2% of the amount of the risk that you are taking. So you have been compensated for the same. But there is one important component that is called beta over here, which is the degree to the company's equity return with the return of the overall market. So it mimics the exchange, mimics the index. Beta is a function of both business risk as well as the financial risk, and it is a measure of the systematic risk. So what exactly is beta coefficient? See, the beta coefficient formula is basically the financial metric, okay, that measures how likely the price of the stock security will change in relation to the movement in the market price. So the beta of the stock or security is also used for measuring the systematic risk associated with these specific investments. So beta is basically the degree of the change in the outcome of the variable for every 1 unit, change in the predictor variable. A standardized beta compares the strength of the effect of each individual independent variable to the dependent variable. So the greater the absolute value, so the absolute value, if it is greater the value of the beta, the stronger will be the impact, right? So beta formula is used in CAPM formula, that is the CAPM capital asset pricing model, to calculate the cost of equity. And the cost of equity is calculated as we just saw RF plus beta into risk from the market minus the risk-free rate, which is your risk premium. Now, beta coefficient meaning. What exactly is the meaning of the same? So the beta is calculated in the CAPM model, computing the rate of return of the stock to the portfolio. And the beta calculation in Excel is a form analysis, since it represents the slope of the security characteristics line. That is basically the straight line which is indicating the relationship between the rate of return of the stock and the rate of return to the market. This can be further be ascertained with the help of the beta formula. Now, the beta formula is something like this. Beta is equal to the covariance of X and Y. Over here, X is basically your return from the market, RM, okay, and Y is your return from your stock. So RS, that is our stock, and our market, that is your X and Y. Divide by, you'll need to divide this whole thing by that is we call as the risk of the market. So risk, basically the variance, you can say, of the market return. So this is going to be your formula for beta, right? The meaning over here is quite simple. If the coefficient, that is this beta, if the beta is is 1, if that is equal to 1, then the price of the stock of the security is moving in line with the market. But if your beta coefficient, if it is less than 1, this is equal to 1 and this is less than 1, then the return of the security, is less than, or you can say the security return is going to be less than respondent to the market. But if your beta, if that is greater than 1, then in that case your security return is greater than the market. That means the security are more likely to respond to the market movements, thereby also making it to be more volatile. Let's take an example. In Apple Inc., beta was close enough to in the neighborhood of 1.46. It indicates that the stock is highly volatile and it is 46% more likely to respond to the movement in the market. On the other hand, let's say Coca-Cola has a beta coefficient of 0.77, indicating the stock are less volatile and 23% less likely to respond towards the movement in the market. So as a trend, it has been observed that the utility stock have a CAPM beta of less than 1, right? On the other hand, the tech sector, the tech stocks, okay, if we talk about the tech stocks, have a beta coefficient of greater than 1, indicating a likelihood of higher returns with more associated risk. So we'll take an example of Make My Trip and MMTY and the market index of Nasdaq. Okay, there are 3 beta formulas that one can go for: the beta formula, variance covariance method, okay, the slope function in Excel, and the regression formula. Okay, so let's evaluate. So we'll start with a step-by-step approach to handle this. First, you need to download a historical prices and the Nasdaq index, so to mimic the same. Here the things have been downloaded over here for Nasdaq dataset, and for Make My Trip prices, refer the URL as it is suggested. These are the historical prices that you have been shown over here. Try and select them. The next thing is sort the prices as per the data. As you can see, the prices dates from the oldest to the newest have been sorted, and accordingly all the numbers will be sorted. Step 3 is going to prepare the beta coefficient Excel sheet as per the data given above. So the Nasdaq adjust and close and the Make My Trip, so there will be some percentage change, and the single sheet containing the corresponding prices data will be there. Then calculate the daily return. So the return is basically the HPY, the closing share price minus the opening share price divided by the opening share price. So basically you will calculate the same and you will get the return changes. So calculate the daily returns and then calculate the beta formula using the variance and covariance method, which we just learned, right? How to calculate the covariance. So in this you would need 2 formulas. One is called variance, another is covariance in Excel. Variance divided by the covariance formula. Once you do that, you can calculate the beta using the slope function in Excel. And again over there, in Excel there is a function that is called slope, and for the same you can use the formula and get the answer. Using the slope function, we can get the beta as 0.9859 based on the data that you have accumulated, and just apply the formula. Even the how to use the formula Excel shows us, and that's how we calculate the beta coefficient regression. Okay, so in that you can go to data analytics to use the regression function. Use the data analysis from the data tab on your Excel worksheet. So this is how the step-by-step approach will go. And the last thing that we'll discuss is the negative beta. See, a negative beta formula means an investment that moves in the opposite direction, okay, against the stock market. See, when the market rises, the negative beta tends to fall down, and when the market falls, it moves in a opposite direction. So since gold is more secure store of value than other currency, a crash in the market prompts investors to liquidate their stocks and convert into currency, like for a zero beta, or purchase gold in case of the negative beta coefficient, and so on and so forth. So a negative beta is not highlighting the fact that there is an absence of complete risk. You cannot say that. but it means that the investment offers a hedge against unforeseen market downturn. However, if the market continues to rise, a negative beta coefficient strategy is losing money, which is quite, common sense based, through opportunity risk, loss of specific change to earn higher returns, and also inflation risk, that is the rate of return not keeping pace with the prevailing inflation rate of the company. Thank you everyone.